Ladies and gentlemen, I'm back with equity. We start with securities exchanges. There are two kinds. We have shares which trade on stock exchanges and bonds which trade on bond markets. Securities markets are not only places where people in the financial industry make a lot of money, but also they have an economic purpose. And that purpose is to facilitate economic activity. The characteristics of a well-functioning securities market can be thought of as 4 items. First, we have a market should provide timely and accurate information on price and volume of past transactions, and also on current supply and demand conditions. The second characteristic of a well-functioning securities market is liquidity, which is the ability to buy or sell quickly at a known price. Liquidity consists of marketability and price continuity. Marketability is the ability to sell a security quickly. So if you have some security and you have a sudden need to sell the security, if the security is liquid, you should be able to sell it quickly. Price continuity is when prices don't change much from one transaction to the next. In the absence of news, of course, if suddenly some very important news comes about the security, then there could be a sudden and large change in price. And price continuity occurs because there are numerous buyers and sellers who are willing to trade in that security. The third characteristic of a well-functioning securities market is internal efficiency, by which I mean low transaction costs. So it should not be that if you wish to sell an asset or somebody wishes to purchase an asset, there should be a very large transaction cost preventing the trade from happening, because we want assets to be put to their optimum use, and transaction costs are a barrier to assets finding a home where they would have their optimum use. The fourth and final characteristic of a well-functioning securities market is informational efficiency, and that means prices adjust rapidly to new information. Prevailing market prices reflect all available information regarding the value of the asset. Now remember, the function of markets is to enable efficient allocation of resources. So markets are supposed to provide information to agents for them to be able to allocate resources which result in optimum production and consumption. So you should have asset prices which reflect information so that efficient allocation is possible. Primary and secondary capital markets are markets in which shares are traded. In the primary capital market, we have the sale of new issues of securities. For example, new shares issued by firms whose shares are already trading. So the firm which has already issued shares, when it issues a new batch of shares, that would be called a seasoned or secondary issue. The second form would be first time issues by firms, so whose shares have not yet started trading. So this is the first time that they're issuing shares, and that is called an IPO. Most large issues are sold with the aid of an underwriter, which can be a large investment bank. The underwriter provides three kinds of services. First is origination, which is design, planning, and registration of the issue. The second is risk bearing. That is, they also share the risk of the issue. And they do that by also purchasing the security. Suppose the security does not sell, then they commit to purchasing it. So basically what this does is that it tells prospective buyers, hey, this must be a good security, because if it doesn't sell, we'll buy it. So we are risking our own capital on purchasing it. So you can trust us. Finally, the underwriter aids in distribution of the issue, that is, sale of the issue. So they have contacts with various kinds of buyers, could be institutional buyers, for example. So they aid in placing the securities. Corporate bond and stock issues are almost always sold with the aid of an investment banking firm. The relationship between the issuing firm and the investment banking firm can be one of three kinds. The first would be competitive bids, where the issuer basically tells the investment bank that, hey, I have this issue, tell me what is the highest price for which you can underwrite this issue, or alternatively for a bond issue, what is the lowest yield. But what that means, of course, is lower profits for the investment bank, which they don't like, but also a weaker relationship between the issuer and the investment bank. So what you will see, this kind of a relationship will mainly be with, let's say, utilities, which are required by law to get the best price. For a large private corporation, they may not just care about a bit more money for the investment bankers, they want a deeper relationship with the investment bank for the longer term. The second, which is the most common for corporate issuers, will be negotiations. Where they talk to the investment bank and they kind of go back and forth. They talk about the issue, the merits of the issue, and then they come up with an agreement about how the investment bank is going to market the issue. The third is best efforts, where the investment bank does not actually take the price risk, which means the investment bank does not actually underwrite the issue. If it doesn't sell, it doesn't sell. The investment bank is not responsible for it not having been sold. So why would an issuer agree to such and deal with the investment bank where it's just best efforts, like the investment bank is not guaranteeing anything? Well, it could be because it's a speculative issue. So the firm may have great prospects, but there's a lot of risk. So people don't really know about the firm, and the investment banks are not ready to underwrite the firm, and that is why the investment banks agree to sell the issue on a best efforts basis.